Did you form an LLC because someone told you that it was going to save you on taxes? Then you need to stay here for the next 15 minutes. Because the truth is, an LLC does not save you a dime in taxes. In fact, if you're making over six figures, it could be costing you thousands every single year. I'm Sonia Moreno, and I help business owners and real estate investors structure their entities the right way. I help them make sure that they're not paying more to Uncle Sam, and that they're actually starting to build real wealth. Today, we're going to break down LLCs, S Corp, understanding when you change those setups. No jargon, no complicated tax code, just real stuff that you need to know. The things that your CPA should have been having a conversation with you years ago, but they get busy during tax season. So let's get into it. So let's start with the biggest myth of small businesses, that forming an LLC automatically is going to save them in taxes. And it doesn't. Think of an LLC like a legal raincoat, right? Where it's going to protect your home and your cars and your savings from getting wet, right? If the business were to get sued. And it is important, don't get me wrong, it is important, but it doesn't have anything to do with how much you pay in taxes. Here's what most people don't understand is that when you form an LLC, and you do nothing with it, the IRS basically ignores it. They actually call it a disregarded entity. That sounds like such a rude name, right? If you think about it, like, excuse me, IRS, I worked hard to form that paperwork. But what it means is this: you get taxed exactly the same way as if you didn't have an LLC at all. So let's just say that your business starts off making $100,000, right? And you're going to pay something what's called self-employment tax on every dollar of that. That's about 15% just for Social Security and Medicare. That's over $15,000 before you even get to regular income tax. And here's where it gets worse. A lot of business owners think that because they have those three letters behind their name, right? They're LLC, they're optimized, right? They're legit, right? I mean, at this point, it's on their business card. So they're like, hey, I'm almost a Fortune 500 company. So they don't talk to an advisor. They just keep doing their taxes the same way they did every year. And then they get to April 15th and they're like, why is my tax bill so high? Here's the truth. Your LLC isn't saving you money unless you tell the IRS how you want to be taxed. And there are different options, and we'll talk about one of the biggest ones in a minute. But the LLC itself is just the container. The tax savings come from what you put inside that container. So if you're sitting here thinking, I have an LLC, I'm good, I need you to ask yourself, have you actually chosen how you want to be taxed, or are you just on autopilot? All right, so let's talk about something called S Corp election. This is one of the biggest ways to reduce your taxes if you're making good money, but you have to do it right. First, I want to clear up something, right? An S Corp is not a different type of different type of business. It's actually a tax choice, right? So you don't go down to the Secretary of State and say, hey, I want to set up an S Corp. You actually have to go to the IRS and tell them, hey, I want to be taxed this way instead. So here's how it works, and I'm gonna make this really simple. So normally, if you have an LLC, you're gonna pay the self-employment tax of 15% on all your profit, every dollar. But with the S corp, you get to split your money into two. So you get to take salary and a distribution. So let's say that you pay yourself a salary of $70,000, then you're gonna run payroll and you're gonna take out taxes just like a normal job, right? IRS is happy. The other $80,000 you're going to take out as a distribution. And guess what? You don't have to pay the 15% self-employment tax on the distributions. So, if you have making $150,000 and you were just an LLC, you would have to pay 15% on the whole 150,000. That's $15,000. So instead of paying 15% on the 150,000, you only pay it on the 70,000. That saves you over $12,000, which, by the way, that's a very nice vacation or a used car or, hey, even therapy when you get out of tax season. But here's the catch, and this is important. Your salary has to be reasonable. You can't pay yourself $20,000 and then take the other 130 in distributions. The IRS is going to notice, and I promise you, they have more attorneys than you do. Your salary needs to be what someone doing your job would actually get paid. So if you're a consultant making 150,000, you can't pay yourself minimum wage and hope nobody asks questions. Now, the S corp also comes with extra work. You have to run actual payroll, right? You have to have better record keeping, and you might need to pay for a payroll software or some kind of service. So if you're only making 50 or 60,000 in profit, the savings usually aren't worth the hassle or the cost. Let me tell you when the S corp is actually the wrong choice, okay? That because this is important, it matters too. If you're just starting out and you're losing money in those first 2 years or so, the S corp can make it harder for you to use those losses to reduce other income you have, like from your regular day job. So if you're a real estate investor and you're doing short-term rentals and you want to use your rental losses to offset your other income, an S corp can mess that up. Basically, you're accidentally outsmarting yourself, which I've seen happen more times than I want to admit. So if you're planning to bring in investors, or and perhaps you're going to sell your business soon, there might be other options that make that easier. The point is that an S corp is a really good tool for a lot of people, but it's not the only tool. And the right choice is going to depend on how much you're making, what kind of businesses you have, and like what are you really trying to do? All right, if you own rental properties or you invest in real estate, this part's for you. Because most investors have their properties set up wrong and it's costing them. Let's start with the basics. If you have all your rental properties in one LLC, you're taking a big risk. It's like putting all your eggs in one basket, except the eggs are your rental properties and the basket is a legal structure that could fall apart if one tenant sues you. Here's what you should do instead. Create a holding company at the top and then put each property or group of properties in its own LLCs underneath. So think of it like a family tree, right? The parent company at the top owns all the babies, which are the individual LLCs. So if one of the kids get in trouble, then at least all the other ones are protected. And why does this matter? First, it's liability protection. If someone gets hurt at one of your properties and sues you, they can go after that. They can only go after that one LLC, not your whole portfolio, not your personal savings, your cars. Second, it's tax flexibility. Each property can be taxed differently depending on what makes sense. Some might be a simple structure, others might have special tax treatment. You get to choose based on what the property is doing. Now, here's something most investors don't know. If you're doing short-term rentals like Airbnb or VRBO, anything where people stay in it less than a week on average, then you might be able to use a tax strategy that lets you deduct those expenses from your regular income. So if you have like a W-2 job or another business and your short terms are losing money, then this strategy might be good to offset that income. But, and this is a big but, if you set up that property as an S corp, you're going to lose the benefit. That tax election kills the strategy. So, you have to think through it and what you're trying to accomplish before you pick that structure. This is why you can't just copy what your friend did with their rental property. What works for them might not necessarily work for you. And one more thing, if you're buying a rental property and no one's talked to you about the the cost segregation study, I think you might be leaving some money on the table. Here's what it is in plain English. Normally, when you buy a rental property, right, you're going to write that cost over slowly, about 27 years, little by little. But with the cost segregation, it helps you speed that up. You're hiring someone to break down that property into parts like, the floors, the HVAC, the appliances, the landscaping, and you get to write off some of those parts way faster, like in the first year. That means bigger deductions now instead of having to wait decades. But here's the thing. This only helps you if your business structure can actually use those deductions. If your setup doesn't allow it, then the tax breaks just sit there doing nothing. Like when you buy that gym membership you pay for but you never use. So this is why real estate investors need more than just someone who files their taxes. You need someone who actually understands how to fit all these pieces together. So, how do you know when it's time to restructure your business? Let me give you some simple benchmarks, okay? If you're consistently making 80,000 to 100 in profit and you're still set up as an LLC, then it's time to change. Just switching to an S corp could save you $10,000 to $20,000 a year. That's real money. That's not clipping coupons to save $50 money. That's like taking your family on a vacation money. Bringing on a partner, right? What if you're adding a business partner or bringing in investors? You need to upgrade your structure. You need clear legal documents that's going to say who owns what, how profits get split, and who makes decisions. Because nothing ruins a business partnership faster than that vague agreement made over coffee that no one even remembers in 6 months. So, if you started as a side hustle and now you're doing multiple six figures, you're hiring people, managing contractors, you've outgrown your basic setup. You need real payroll systems, you need better bookkeeping, and a structure that can handle your complexity. You can't run a $500,000 business on the same setup you used when you were freelancing from your couch in 2019. Well, I mean, you can, but it's going to cost you. Getting married, buying a house, planning to sell your business some days, these are all things that you should be thinking about, and you should review your structure. What worked for you when you were single and making 50,000 doesn't mean the same when you're married, managing a team and clearing $500,000. And here's the good news. You don't have to wait until January of the next year to make these changes. You can restructure mid-year and still save money on those taxes. If you make the change by March 15th, you can apply it to the whole year. If you miss the deadline, you can still do it, and it counts from that point going forward. So every month that you wait is another month of you overpaying. And I don't know about you, but I'd rather keep that money than donate it to the federal government out of the kindness of my own heart. Here's what I want you to remember. Your business structure isn't something you set up once and then you forget about it. It needs to change as your money grows, as your business grows, and as your life changes. An LLC by itself doesn't save you on taxes. S Corp can be an amazing tool for the right person at the right income level. Real estate investors need to protect each property separately and think strategically about your taxes. And if you've outgrown your current setup, changing it can save you thousands. If you're watching this and thinking, I have no idea if I'm set up right, that's exactly what I do. I help business owners and investors get their structures right so you can stop overpaying the IRS and start keeping more of what you earn. If you want to talk more about your specific situation, the link to schedule a strategy call is in the description. Let's make sure your business is set up to actually work for you. Thanks for watching, and I'll see you in the next one.